Did Jamie Gruber get it wrong regarding taxes in the Dominican Republic? What am I referring to? Recently, Jamie Gruber uploaded a video to his channel on YouTube called "Don't Buy Property in the Dominican Republic Until You See This." And the video was regarding taxes and owning property in the Dominican Republic in regards to rental real estate and personal property taxes. So the question is, did he get it right or did he get it wrong? But before I address the answer to that question, let me introduce myself. My name is Javier Diaz, and I'm a certified financial planner, and I focus on working with U.S. individuals who live part-time, full-time, or invest in the Dominican Republic. So back to the question at hand. Did Jamie Gruber get it right or wrong? He got it mostly right. Jamie got it mostly right. So one of the things Jamie covered was property taxes. So he got that absolutely right. You add up all of your properties in your portfolio, especially when you own it in your own name, and it's taxed at 1% above a certain threshold. The threshold for this year is actually 10.8 million pesos or so, right around there. So depending on the exchange rate, currently it is a little bit higher than $170,000. So anything above that amount, you pay 1% on for your property tax. So that's absolutely right. One thing to expand here to call out is that property tax, you do pay it in 2 installments. The first one in March and the second one 6 months later in September. Now, moving on to owning the property for a rental business to rent out. First, Jamie covered owning it in your own name, fee simple, right? Now, Jamie did qualify here and say he wasn't 100% sure that there might or might not be a way to deduct expenses, but his understanding was that mostly you cannot. Well, not in DR, but there you go, a moto for you. So here you absolutely can own property in your own name and rent it out and be able to deduct expenses. So any business here that you operate here in the Dominican Republic, you can operate as a sole proprietor in U.S. terms to understand. So, and this does include rental property, so you can own rental real estate, rent it out, and deduct all the same ordinary necessary expenses to operate your real estate business. So here, your net income will be lower after taking all the legal deductions, and your tax bill will be lower than what Jamie stated. So it is absolutely possible there. So mostly right, but again, good to expand on. Next, Jamie talked about owning the properties in an entity, be it a U.S. LLC or an SRL, which is a Dominican limited liability company. So here we talked about taking all the deductions, ending up with a $13,000 net income for the rental income, and having tax on it of $3,500, which is at the corporate tax rate of 27%, but actually paying $4,500 due to the asset tax when you have an entity. So it's good to expand here that the asset tax, what that is sort of, again, in U.S. terms, so that you understand, is sort of an alternative minimum tax, or AMT as it's referred to a lot in the U.S. So here, if you own assets that are producing less than the income coming in, and here it's good to also point out that the reason why the DR has this is for that, so that you don't have, you don't amass a ton of assets that are unproductive. In other words, not adding to the economy. So that's why they have this alternative minimum tax of asset tax, where if your taxable income, which ends up having your tax liability being lower than what the tax is on the assets in the entity. And here we can show you a perfect example of where assets that are unproductive will cost you more than assets that are actually being productive. So in Jamie's example, again, $13,000 of net income, $3,500 corporate tax rate of 27%. So the tax liability there would be $3,500, but the alternative minimum tax or the asset tax, 1% of the $450,000 portfolio, ends up being $4,500. So obviously here, as Jamie pointed out, the income tax on the rental, that income is lower than what the asset tax is, so you would have to pay the asset tax. And here's where I really want to point out and expand. So you're paying $4,500, right, from taxes. You had $13 net income, and let's just say, for simplicity's sake, let's say that the expenses that we're accounting for are expenses that hit your cash flow, because obviously you can deduct depreciation, which is not a cash flow item. But let's say here all of our deductions are cash flow items. So let's say cash, you have $13,000 and you have a $4,500 tax bill to the Dominican Republic. So you pay that, and now you have $8,500 left, right? Well, you gotta eat, you gotta spend that money. So in order to spend that money, you need to take that money out of the business, out of the entity, and you do that through distributions, through dividends. Now, when you distribute that $8,500, the Dominican Republic has a 10% tax on that dividend. So again, just like in the US for corporations, there's double taxation going on with corporations in the Dominican Republic, right? So you're paying taxes on the income, the net income that the company makes, or in this case here, the asset floor, the alternative minimum tax. And then on top of that, whenever you take a distribution, it's 10% of the dividends distributed to you. So in this case here, that's another additional $850 that you pay in tax. So $4,500 plus the $850. Okay, you add that up, you divide that by our $13,000 net income, and you're looking at an effective tax rate of 41.15%. Yes, 41.15. What does that mean in dollars and cents? That means for every $100 that you make, you are giving the Dominican Republic government $41.15. Wow, bet you didn't see that one coming. Now, how can you lower that? How can you put more in your pocket? How can you get closer to the 27% or an effective rate of 34%? It's very easy. Make more money. That's right, make more money and pay less tax. Sounds like an oxymoron, but it's absolutely true, for the fact that I pointed out earlier of that the asset tax is sort of like a penalty for having assets that are unproductive. So just here, sticking with all the same numbers, right? The same rental income of that Jamie stated here on the 3 properties, instead of making $13,000 net, let's say you grew your top line rental income or reduce your expenses. In either case, right, you either increase your income top line or you reduce your expenses. That means more money, more cash in your pocket, right? So here, by increasing your net income from $13,000 to $16,666.67, I know it's a very precise number, but that is the number that will get you to an effective tax rate of 34.3%, which, when you take that into account of a 27% corporate tax rate and then a 10% double taxation on the dividends distributed. Okay, when you do the math on that, on paying the taxes and then taking the distribution, that's what you end up with, a 34.3% effective tax rate. So the goal here is to get above a certain amount where you're down to paying that. Instead of paying an effective tax rate of 41.15%, you want to be paying 34.3%. Okay, and here and in this example, all you have to do is get your income, your net income, up to $16,666.67, and at that point you are at the 34.3, and anything above that you're going to be at the 34.3. Again, that's a combination of the 27% corporate tax rate plus the 10% tax on the dividend distributions. So there you go, make more money, pay less tax. All right, at least there you're keeping it more of every dollar that you're putting out of the business. All right, now another thing to kind of call out here was the fact of whether you own an SRL or an LLC. Now, Jamie did point out that by owning an SRL, you might have more of a handling or carrying cost by having to file monthly filings with the DGII. That is absolutely true, but what is also true is that if you own an LLC registered in the Dominican Republic, you are subject to those same monthly filings. Why? Because even though your LLC is registered in the US, here it is registered as an entity here, as a company doing business here, and it must follow the same corporate laws, including taxes and all the necessary filings. So whether it's an LLC, a US LLC, or a Dominican SRL, you still have to do those monthly filings, which is your 606, your 607, etc. We won't get into all of those here. So another thing to mention, okay, Jamie also called out that you can get more information like this within the inner circle, and that there's a suite of professionals in the inner circle, in the tax chat, that talk about things like this and help people out like that. Well, I'm one of those professionals. I am a member of the inner circle, and if you're not a member of the inner circle, I highly recommend you sign up. So go to jamiegruber.com and sign up for the inner circle there. Okay, as you're thinking about your move to DR, whether to live or to invest, think of this: watching my video, watching Jamie's videos, as level 1. Okay, you're gathering information. That's your level 1. Your level 2 would be joining the inner circle. Right there, you'll meet up to hundreds and hundreds of people. I think it's up to over 1,000 people now who are members in the inner circle, sharing again their personal experiences and what they have done in the Dominican Republic, and also again speaking with professionals like myself, who is also walking on that same journey along with you. So that is your level 2. Your level 3 is when you're ready to take action. When you're ready to take action, that level 3 is working with professionals like myself, or an attorney or an accountant in the Dominican Republic and in the US as well. So information is just noise without action. So first action, subscribe to this channel, give it a like, this video, share it to anybody you think can benefit from it. Action item number 2, again, go to jamiegruber.com, sign up for the inner circle, and I'll see you in there. And until the next one, take care.